when should one take profit? And this is a question that we get all the time from clients. And as you can see, just a couple of weeks ago, I received this email from a client asking when he should take profit as he was up over 100% on one of the stocks we have under coverage. And that stock was actually Cipher Pharmaceuticals. And unfortunately, I said to this client, the answer isn't always as straightforward as most would like. It needs to be taken on a case by case basis for each stock which you own, and ultimately depends on the underlying financials of the business. And we went through some examples together over the phone so he could kind of understand what I was meaning. So, in this section, I will touch on the issue of how to hold a great stock long term, and we'll run through a case study example from our past coverage so you can understand when you should either take some profit on a stock, hold, cut your losses, or potentially even buy more. So, before we jump into the case study I have, I'm just going to quickly show the framework which we will be assessing the example on. And like I already mentioned, we need to look at the decision from the perspective of why the stock went up or down and how the business fundamentally looks today. And this includes, why did the stock go up or down, and is the move justified? Was it driven by good financial results, some kind of news, macroeconomic factors, or simply just sentiment driven? We need to look at what type of business we are dealing with. Is it a stable growth stock, contract driven, commodity based, or cyclical or defensive? Now, if the stock is contract driven, cyclical, or commodity based business trading with elevated valuation multiples, we would typically be more prone to take profit if the stock is up, given these businesses have more volatility in their financial results. And the last here, what are the valuations looking like relative to its growth outlook? Is it fair value, undervalued, or overvalued? So, the case study here is on Photon Control, PHO, on the TSX. They are a manufacturer of optical sensors and systems to measure temperature and position for semiconductor manufacturers, which tends to be quite a cyclical industry. And we originally recommended the stock in 2014 at 46 cents per share because the business had strong backlog over the previous year. So we anticipated growth in the business, and it traded at just 8 times earnings. Then in fast forward to 2018, the stock traded at $2.40, up 420% since our initial recommendation. We reassessed the business and decided it was diligent to take profit given the volatility of the cyclical semiconductor sector, along with a heightened valuation at 24 times earnings. And we basically repeated this process from 2020 to 2021, re-recommending the business at 88 cents, as the business's backlog again grew substantially, indicating there was a growth path ahead of it. And based on our earnings estimate, it was trading with a forward price to earnings multiple of about 8 times. And finally, advising clients to take some profit in the $2.70 range while growth was slowing. Management noted that on the conference call, and the valuation again became elevated. And just a few weeks later, the stock was bought out at a large premium at $3.60 per share by MKS Instruments. So again, to go over our framework, the reason for the share price move was due to a surge in backlog and EPS growth. So it was certainly justified. But again, earnings are quite volatile with this cyclical contract-driven business, which made us more prone to take profit when it traded with elevated valuation multiples and when it also appeared that growth was slowing. Now, if a stock goes down, you can also do the same process, which I followed here. Look at the business from a fundamental perspective, understand what kind of business it is, why the stock has gone down, and determine whether you should cut your loss and move on to a better opportunity or if the investment thesis remains intact. Now, again, I did say this earlier, but in the webinar that we recently did, that can still be purchased on our website on demand, we go over another example from a stock that is currently under coverage. And despite that stock running over 100%, we would actually continue to buy more rather than take profit given the increase in its earnings, as well as it's a relatively stable business model and it has a reasonable valuation in relation to its growth path. Again, all despite the stock being up over 100% since our initial recommendation. So yeah, that's my segment. Again, I think that there's some good takeaways here, especially like, just looking at a business. Is it cyclical? Is it commodity based? Is it stable? Is it defensive? Even just looking at a business from that perspective can definitely help someone understand whether they should or should not take profit.
Yeah, I love that categorization of the defensive, the stable growth, the cyclical, because that really determines where a company falls in terms of those categories, determines like, well, what's reasonable debt leverage that they
Yep.
can carry, right? So the debt leverage for a mining company is going to be different than for a utility company, for example, right?
Yep.
As well, valuation, right? Growth expectations. Um, yeah.
Yeah,
Perfect.
no, I believe it's a good summary, and that's how we categorize when we're actively looking at whether or not we want to take a profit on a company, take half the position out, whether or not this company has that cyclicality to it, whether or not we're tracking the backlog in the business, if it's contract driven, or is this a SaaS business that we don't see much cyclicality in, or is it a recession resistant business and then it's still trading at reasonable valuations and we want to own this company long term. Those are the determining factors we make. So it is always on a case by case
Yep.
basis when you're looking at, there is no one size fits all rule.